Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, welcome again.
Always great to be here.
All right, we've moved to sweaters. I didn't bring mine today, but ties to shirts. I know it's.
I need to mix it up. Like it was nothing but sort of a typical Brooks Brothers blue shirt for the first 142 episodes. So I've mixed it up now.
That's great. Hey, listen, we have a really interesting show today. And it's going to be about indices. We've had a lot of conversations with people about indices, where they fit in the products, and we thought, hey, listen, why don't we actually bring some actual experts on who run one? And today we have representatives from the Nasdaq-100 index, and I am going to say, full disclosure, my company by day, we are proud partners with Nasdaq-100. We just actually added the Nasdaq-100 to a number of our flagship FI products. But we just want to go deeper and understand what it is. And I'd like to welcome two individuals, Efram Slen, who is the head of index research, and Marex, who is the senior specialist senior specialist of the Nasdaq Index Research function. Mark, I think I clobbered your title.
You're totally fine.
All right. Hey, Efram, Mark, welcome.
Glad to be here. Thanks for having us.
Hey, thanks. Hey, listen, first question is Nasdaq indices, Nasdaq index. You kind of say NASDAQ, and somebody says, oh, yeah, the NASDAQ index. But I know the world's a lot more complicated than that. Can you just kind of lay out, maybe, Efram, when we say index, what index are we talking about? How many indices could we be talking about that the NASDAQ is responsible for or creates?
Thanks, Paul. There are actually over 45,000 indexes that NASDAQ calculates, right? Just like some of the other big index players out there, there are actually hundreds of thousands of indexes that are calculated. There are only a handful that people really know globally. So when you think of NASDAQ and hear every single day, people say the NASDAQ went up, the NASDAQ went down. That's actually the NASDAQ composite that's usually being referenced. That's the index comprised of all securities listed on the NASDAQ stock exchange. So that's over a couple thousand names, as opposed to the Nasdaq-100, which folks still know. It's very, very prominent. It's the one that's actually the barometer for the Invesco QQQ ETF and the products that you were talking about, right? It's an index comprised of the 100 largest non-financial companies from the NASDAQ composite. So when people tend to say the NASDAQ went up, the NASDAQ went down, they're actually usually referencing the composite, but a lot of times it gets interspersed and confused with that, with the NASDAQ-100, which is where all the products really are tracking.
Yeah, and maybe just explain the mechanics. So a company's in the Nasdaq-100, it's out of the 100. How does that actually happen? Is this monthly, weekly? What's the process? How do you actually manage something like this?
So actually, back in 1971, maybe I'll even give this kind of breakdown. So back in 1971, when NASDAQ, the exchange, launched, that's when the composite was created. 15 years later, we launched the Nasdaq-100 as the tradable version, right? So once a year, since 1985, we have an annual reconstitution. It's a rules-based, transparent process where the 100 largest non-financial companies are selected. That happens every December, and it's called the Quad Witch Day, and the third Friday of December. The other 3 quarters, it's just a rebalancing that occurs, right? So weights are reviewed and ensured that they're meeting all the regulatory elements there. So where necessary, capping might be applied. So that's it. Again, in a nutshell, the Nasdaq-100. Again, once a year, that's when names are added. Again, they need to be non-financial and they meet a variety of other criteria, but the most important being that they're listed on the NASDAQ exchange.
Are there who actually makes the decision? So if you look at the indices that are out there, you've got S&P indices, which are actually in some sense actively managed, and then you have Russell indices, which are truly rule-based. Where do you stand in terms of what determines what is added or deleted? Does somebody make a decision? Is there a committee? How is that managed?
I'm glad you asked that, Ramsey. So we are entirely rules-based. It's something that we really pride ourselves on. And interestingly, so if you look back at the Nasdaq-100, one of the things that made us unique compared to the S&P 500 in particular, is that Tesla, right, made it into the Nasdaq-100 in July 2013 when it was first eligible at a market cap of around $15 billion. Fast forward seven and a half years later, when the S&P committee said, yeah, it's eligible for the S&P 500 now, it was at a market cap of $660 billion, right? So, yeah, we're rules-based, transparent, we're really proud of that.
Interesting. So you brought up Tesla. When I think of NASDAQ, I think, okay, tech. Tech. I guess, what type of misconceptions do people make when they think of NASDAQ and put technology and Tesla in the same bucket?
So we actually think of Tesla as, yeah, it can be a tech company for sure. It's also an auto company, right? There's a lot of great things that they're doing. Look, I said this to a colleague and some friends the other day. A neighbor of mine just put solar panels on their roof made by Tesla. One of the coolest things. I think it's the nicest roof in the block. They do a lot more than just create some of the nicest looking cars on the road. But yeah, it depends how you want to look at it, right? They're an innovative organization. That's actually the core. That word innovation, that's what we think of when we think of the Nasdaq-100 or even the Nasdaq listing venue in general in our company. That's, again, it's a very, very often used word, but the reason why we tend to think of it, it's just not just technology in and of itself. So if you look and you break down companies within Nasdaq 100, right, some of the biggest names, right, that come up that you could probably think of, right? You have Alphabet, you have Amazon, Microsoft, Apple, Meta Platforms, and so forth, right? So some of the biggest names out there, but not all of them are actually classified as technology by your general classification standards. Actually, only a handful, only about half of those were. Some of them are consumer discretionary, right? Where does Amazon actually fit? Right, they're the biggest cloud provider in the world, but where do they fit?
Are they grocery store? I don't know, right?
Are they grocery store? That's right. So they're actually classified as consumer discretionary. So that's a fun thing when it comes to classification. A lot of it's just perception, and a lot of it just comes down to how the rules from classification systems are actually putting companies into buckets.
So you mentioned that the companies have to be non-financial. So I thought I actually was not aware of that, and so I'm curious. In a world where financial used to be something very clear before, it was sort of balance sheet intensive, banks, insurance companies, et cetera. But now we live in a world of fintech where there may be balance sheet, it's balance sheet light, and the technology is sort of a more sort of important part of the description of the company. Like, where does fintech sit from your perspective?
So we have to utilize, again, this goes back to being rules-based transparent. We actually outsource the classification. We don't make those decisions ourselves. We utilize the industry classification benchmark system to determine, again, are they financials, are they not? Where do they fit within the ranking? So we don't include any companies that are classified as financials according to that benchmark, that classification system, again, called ICBs, the benchmark. So companies like NASDAQ ourselves, we're excluded, like T. Rowe Price, like CME Group, that are listed here in NASDAQ, and we proudly have them listed here. They're excluded as a result of that classification.
Yeah, interesting. So if I were, an independent financial advisor presenting NASDAQ 100 to clients, what would the composition look like, 10 years ago versus today? I mean, clearly some of those names are still there. You mentioned Tesla was in there. I bet Amazon, I bet Google was, but what have been the major shifts, like from then to now?
So definitely been some that we've seen even more so over the last couple of years, right? Companies like Zoom rising to prominence, right, with the work from home trade that we've seen over the last couple of years. But to be perfectly frank, the stories just continued to evolve, and the important dynamic here is that we try and make sure folks understand is that the Nasdaq 100 itself, post the tech bubble and burst, it's a far different story. So even 10 years ago, the story is actually pretty darn similar today as it was 10 years ago. It's the prior 10 years that we're trying to ensure that people don't have in the back of their minds.
So one of the things that we chatted about, ahead of the show is sort of the profile of the Nasdaq and the Nasdaq 100 in the market. So we're in a place where over, call it the last, really is 10 years since the first custom index came out, but probably 6 or 7 before they started coming out in real numbers. There's been an explosion of customized indices in the FIA space, And tell us a little bit about I don't know, how you feel about competing in that market, and why you think your index is something that's a familiar one, is for many people maybe a better way to go.
The Nasdaq-100, the way we think about it, there are many different spots that it can fit into a portfolio, or at least from an index perspective, right? It can be a large cap play, it can be a large cap growth play, it can be a thematic play. There are many different ways, or even a technology play. There are many different ways that this index can fit, and it's really up to, frankly, how folks view that type of basket in their portfolio. So a big part of what we tend to do in our research is compare the Nasdaq-100 to the S&P 500, because we want to make sure, again, like I said before the call, that where the Nasdaq was in the early 2000s to then 2010 to the 2010s to today, just such a different story. We've seen such a big maturation of companies, balance sheets completely changing and flipping on their heads, right? Where today, when you think of the Nasdaq 100, maybe you don't even think that we pay dividends. We do. I mean, it's not a massive dividend paying index benchmark, but it's actually half of what the S&P 500 is as of the end of February at around 70 basis points. But we are fully fledged index here that has index dividend, that has dividend payers and so forth. So again, it's a pretty great story depending on how you're looking to have it fit into your portfolio.
Yeah, I guess, how has the risk profile changed, do you think, of the companies over the last 10 years in the Nasdaq 100? I mean, I would think that if you've shifted from maybe more tech to, as you're describing, more mature companies with dividend paying, you'd think the volatility, the risk might go out. However, the last couple of years have been crazy in terms of market volatility. What's your perspective on, how I would allocate clients' funds to the Nasdaq 100 versus funds indices A, B, or C?
So I actually want to make sure I give Mark a chance to jump in on this. But one thing that I'll comment, even just before he even gets into the answer, is that we're an index provider. We're meant to give a spot for folks to understand and track benchmarks. We're not really giving investment decisions. So I just want to at least caveat the answer there. But
yeah,
Mark, I'll
you.
let you jump in. Thank you.
Yeah, thanks, Efram. I mean, I'll point out a couple data points that we have. One of which is a very long-term kind of graph of realized volatility. When you look at Nasdaq 100 versus something like the S&P 500, which is much broader but plays in that same large cap space, right? The volatility is actually very, very close over the last 10 to 15 years. It's maybe a difference of 2 or 3% a year annualized on average. The really interesting thing, though, that we kind of explored last year, writing up a white paper about what the performance looked like during the COVID bear market, and how that compared to things like 2008, to things like the tech bubble. The Nasdaq 100 actually outperformed in terms of not just the drawdown being lower in March of 2020 than the S&P 500, but also volatility being lower. And I would say that speaks more than anything to the difference in the composition versus 10 or 15 or even 20 years ago. It's not that the sector exposures are necessarily different. Tech has continued to be pretty consistent, 50 to 60% of the index. You get another 20 to 30% of the index coming from things like consumer and healthcare. That stays pretty consistent long term, even though the companies underlying will grow larger and grow smaller and go private and fall out and whatnot, right? But in terms of the reputation that the index has gotten, especially from those top 5 or so names, right? They're almost like a defensive play nowadays, right? They're extremely profitable. They're very, very efficient at generating cash and turning over their assets. They've grown their buybacks, which kind of overshadows the dividend underperformance versus something like the S&P 500. They've grown their buybacks by literally hundreds of billions of dollars over the past couple of years. And that, I think, speaks to, why this index isn't, the same as it used to be 20 years ago, where you had a lot of companies that were, still early stage, still were unprofitable, weren't doing things like dividends and buybacks. Nowadays, you have this very, very solid fundamental core of the index of about 50% of the index is the top 7 companies. And they are all massive, fundamentally strong and sound companies that have this, tail added on top of it of companies that by and large, disproportionately put innovation at the center of their business models. That's what the index is about to me these days, more than anything else.
So another thing that sort of was on my mind as I was thinking about your index is just what kind of assets are effectively under management or benchmarked to the Nasdaq-100. Like, can you give some idea to the audience of the magnitude of whether it's in ETFs or FIAs or if it's in mutual funds? Just even ballpark figures, like how much money is out there that looks to the Nasdaq-100 as its key benchmark in orders of magnitude.
There are hundreds of billions of dollars that track the Nasdaq-100 across pretty much every single financial product wrapper that's been created, right? From ETFs to mutual funds to insurance products, UITs, structured products, futures, options, right? You think of a product, there is a Nasdaq-100 product tracking it in some capacity, possibly even somewhere in the world, right? So there are ETFs in well over 20 countries in the world alone, let alone other product wrappers. The E-mini futures that track the Nasdaq-100 have grown explosively over the last couple of years. So, and the micro E-mini launching out of the CME here as well. So tons of derivative trading going on in a very increased capacity. The Qs hit over $200 billion recently enough and are approaching back up on that. And when I say Qs, that's the Invesco QQQ ETF. So yeah, just hundreds of billions of dollars. That's the short answer there.
Well,
so,
go ahead.
Can I just add quickly to that? So the reason I brought that up is that it's somebody who was in this space in my prior career. Like one of the tensions was always between, all right, you come up with something that's creative and customized, and it may work if you look at history, but is it tradable? And on the other side, you've got something like the Nasdaq-100 and some other indices which are very tradable, which ultimately, in addition to being recognizable, also brings the ability to hedge efficiently, because behind every transaction, every FIA purchase, there's a hedging transaction. So that's something that I think is something that there's not a question here, just a comment, but I think that is an important element of using a broad-based index in the FIA space.
I'll even go on top of that, and I appreciate you saying that, Ramsey. Is that it's great. This index has they said launched 1985, has over 37-year track record, right? So the products have been around for quite a long time. If EQ's launched in 99, right? And that's, again, one of only, I was saying before, many different products and product wrappers. So yes, having that track record absolutely stands without question.
Now, well, of course, from a macro perspective, we just get through COVID, only to have this awful war break out in Ukraine. Tell us, how has this impacted the Nasdaq-100?
So it hasn't from an actual inclusion perspective. So there were no Russian equities in the Nasdaq 100. But like many index providers out there, right, like S&P and MSCI, FTSE Russell, all four of us actually put out announcements to remove Russian equities from all of our index benchmarks.
Interesting. So no change. No, if I were sitting down with a client, no Russian company was in the Nasdaq 100 that would have been pulled then.
That's correct.
Okay, interesting.
So what do you see as sort of the opportunity set in this space broadly? So just as we had mentioned before, a lot of people are getting into the index game. So you mentioned that there are 40,000. Just you alone manage 40 to 45,000 indices. Is that right? Well,
that's right.
What's interesting to me is that I think there are only, the last time I checked, there were like 3,500 stocks in the U.S. market. The Wilshire 5000 doesn't even cover 5,000 stocks anymore. Back when I started, it had 7,000 in it. Right now, now I think it has a lot less. So yeah, I'm curious. Do you have a sense for what the future is in indexes, whether it's broad based or more customized indices? It's been a remarkable proliferation.
There absolutely has been. There are more and more ways to slice and dice things than you can imagine. So of the 45,000 plus indexes that we offer, many of them actually go back to one index. It's a global equity index benchmark of around 9,000 global equities from developed and emerging markets that cover 44 countries. Because again, I mentioned the exclusion of Russia, as well as large, mid, small cap, all cap, large, mid cap, different currencies, different ways to calculate with and without dividends. Before you know it, you've got, again, we could have done it far more the way we did it, but the way we have it today, it's over around 40,000 or so indexes from one basket of 9,000 names. Now, think about that from how the way things have continued to evolve over the last even 15 years in the index space. It started out, beyond 15 years, as just ways for folks to track the markets, right? So there were only a handful of indexes that people really paid attention to. Indexes continued to come to market just in the benchmark variety that are regular market cap. Literally, what is the world valuing these indexes as? And then we started to have some new indexes come to market, right, that were equal weighted, that were fundamentally weighted, different ways to track and select and manage portfolios. And then we started saying, all right, well, what are the active managers doing? How can we try and get exposure to and returns that are like what active managers are doing? That's when the rise of smart beta came around. And it was, where factor indexes came about. So folks were focusing on far more than just value and growth. They're just looking at underpinning data points from balance sheets and financial statements and saying, well, I want to focus in and around this data point. So Mark brought up before buybacks, right? We have a buyback achiever index here. We have many dividend-based indexes here. We have many multi-factor indexes that can look at a wide range of data points. And then over the last several years, thematics has been the new rage, right? That's where folks have been digging into not technology or financials or healthcare. It's fintech, right? It's a smaller basket of names that are focusing on, like we said before, just those specific names. Looking at names that are in cloud computing only, at cyber security only. So you're only going to get 30, 50, maybe 70 names at most in some of these thematic baskets. If you're really pushing up to 70, sometimes far less. And again, that's where we've seen really things continue to evolve. And it's been an awesome thing to be a part of. I've been at Nasdaq over 11 years. It's been a great ride, and watching, frankly, the continued growth and maturation of the space.
Interesting. Well, yeah, tell us just a little bit about both of your backgrounds. So, Efram, you've been at Nasdaq for 11 years. Tell us what got you to Nasdaq. What keeps you totally engaged, as we can tell, in this space.
I just love, frankly, I love coming to work, working with folks like Mark, working folks like both of you in the space where we get to have conversations around the markets, around what we've got going on. But what my job really entails today, I'm responsible for all the research content that we put out across our index business. So when I started here at Nasdaq, I was doing a combination of new index development as well as putting out content, supporting our business. But today, that the role has evolved, and I'm responsible for all content supporting the index space here at Nasdaq.
Yeah, Mark, your background and what excites you most about this particular space in the market?
Thanks. Yeah. I mean, I'm coming up on 3 years with Nasdaq here, and specifically with Efram's team. Took a bit of more of a roundabout path to get here. Like Ramsey, I did my stint at a big New York bank for about 8 years. In my case, Citi. Coming out of college, and my last role there was in sort of a client strategy and analytics role within IBD. But really, for a long part of that time at Citi, my passion was elsewhere and more in the realm of asset management, and specifically systematic strategy, research, and creation and execution. That led me to launching a startup fund with a close colleague of mine to trade U.S. equities long short on a very systematic basis, right? And, very risky endeavor, didn't end up working out long term, but really kind of cemented my desire to stay within that general space of, how do you design, launch, and then support systematic strategies that are data-driven, that are, kind of fully transparent, that offer something unique. And I found that Nasdaq's, value proposition was very compelling from the perspective of, it has this industry-leading index business that is, very much underpinned, just like S&P, right, or MSCI, underpinned by this flagship product that almost everybody knows and has such a great reputation in terms of the Nasdaq-100. But then you have all these other interesting things going on under the hood that people, outside of Nasdaq will really not have any idea about, right? Things like designing indexes with embedded options, whether that is using options to juice your yield or to provide downside protection or to minimize volatility on something like the Nasdaq-100, we do that. As Efram mentioned, the thematic space, that's been such a great source of creativity and trying to figure out ways of how do you define a new industry that is driven by a single technological breakthrough. Do you go pure play? Do you go sort of broad-based in coverage with that? And working with clients every day to figure out, how do we design an index from the ground up that is rules-based, that is transparent, that is replicable and investable. It's a great challenge because there's no single right answer, but I feel like we have these guidelines, these principles that move us in the direction of, putting out market-leading products, whether it's thematic, whether it's smart beta, or something else, day in and day out, and that's really exciting.
Excellent. Okay, so from Ramsey and I have an appointment with a client, I guess at 2:30. We've got 2 hours to prep for this, Ramsey, and oh my gosh, I've got to explain the Nasdaq-100. What's the best place to go to learn enough that I can actually represent your index and the mechanics and what's and the stocks inside it, so that I can give somebody who's trusting me a good understanding of where their money is what their money is going to earn interest credits against.
So there are a few spots where we have kind of content around the Nasdaq-100. So I'll give you kind of both locations and landing pages. So one is Nasdaq.com/Nasdaq-100. The other one, it's a little bit harder to find, but perfectly honest. But if you go to indexes.nasdaqomx.com and you go in the search bar and look for NDX, which is the index ticker for the Nasdaq-100, or just type in Nasdaq-100, and you'll scroll down and you'll be able to find, get on that page and be able to see kind of all the great content there that we have around the index.
Oh, that's great. Thanks, Ramsey. Any final thoughts or questions? This is your space.
So just one quick question. So you've got 40,000 plus indices, and it sounds like you interact very proactively with your clients. I'm wondering sort of what are the various ways they can interact with you. Could some entity? It could be an insurance company. It could be a bank. It could be an insurance distributor, right? Can they come to you and work with you to develop their own custom index that they can launch on their product? Which way do you go? Is it inquiry, reverse inquiry? Can you go both ways? I'm just curious how people can engage with you to create unique product.
It's absolutely both. But our favorite's actually the one that's in between, where it's together. Right, where we come together and say we have an idea and they have an idea, we come together, we work together to create the final solution. And for me, that's the most exciting that I've been a part of, and I know the team kind of loves here. Of course, it's great when someone has their own view and we help them get that out in the market, or we have our own view and we get that in the market. My favorite, though, is when everybody comes together and we're able to create that combined kind of thought into a final index solution.
Okay. Well, hey, listen. Efram, Mark, thanks for your time. We'll put the links in the show notes, and really appreciate your time. Maybe we can another time we can actually come down to the floor when it's we get through this whole COVID and record a show there. Love to do that in New York sometime. So, all right,
that'd be awesome. We'll definitely have to do that.
Yeah. All right. Hey, thanks so much, Ramsey. Thanks. And join us again next week for another episode of That Annuity Show.